Gold right now is trading kind of like that guy at the party who's had way too many drinks and really needs to go home. This thing is in a monster upward trend and shows no signs of slowing momentum. This is pretty incredible when you also take a look at gold miners. Take a look at GDX, which is a gold miners ETF. These are companies, mining companies. This thing is in a massive upward trend, up 48% just since August. And it's not just gold. We also see silver having just an incredible run up here. I'm feeling some serious FOMO because if you are a regular viewer of my channel, you know I got long silver, felt like a genius when it started going up, and then I trailed out right here, took profits, and I was like, all right, that was great. And then, well, silver decided to make the real move after it trailed me out. This is trading 101. Sometimes the frustrating part of trading is that you catch a piece of it thinking you got it, and then the market keeps going without you. Or even worse, if you are stuck on the short side of these moves, this is incredibly painful. And one of the reasons that I often say you do not short a market that is in massive upward trends momentum, you just don't fight it. And that goes for gold, that goes for silver. It definitely goes for the NASDAQ as well, which is also back up to just about its all-time highs. The stock market seems to be sort of rejoicing around a few things, specifically GDP numbers, which last week were much better than expected. We still have an economy that seems to be growing, and the overall output increasing for the economy can largely equate to stronger corporate earnings, which is ultimately what has propped up the market's gains here in the last few years. This week, we will also get some fresh data on the PMI's side of things, which is a forward-looking indicator of economic prosperity or growth or lack thereof. So we'll get some information on that this week. We also had retail sales that came out better than expected. So you have overall a pretty good growth sector or component of the US economic heat map here. But what about inflation? Well, inflation's at 2.9% for CPI, it's at 2.6 for PPI, and it's at 2.9 for PCE. So inflation is still a little bit sticky here. And Fed's Hammock actually this morning said inflation risks outweigh job market concerns, which this is largely what we've been talking about from the Federal Reserve commentary we've done on this channel. Most of the Fed seems to be gearing up towards more concerns around the labor market, but this is interesting to see that she thinks that inflation risks actually outweigh the job market concerns currently. And starting tomorrow, we'll put that idea to the test as we have JOLTS job openings numbers coming out tomorrow at 10 a.m. US Eastern Time. Here's a look at a historical showcase of JOLTS job openings, which has been in a downward trend for multiple years. Hiring and job openings in the US have been slowing for some time. And just to put some context around this, you can see things were actually slowing before the pandemic. And then with the surge in stimulus checks and easing for businesses and lowering of interest rates, we saw a huge surge in hiring that has since been continuously declining for a couple of years now. And at this point, we are now very much just around pre-pandemic levels of hiring, which is not a terrible, horrible jobs market scenario. But if we continue to trend lower from here, it starts to get a little bit scary. The thing about jobs data is it oftentimes kind of follows a momentum path. And so if the momentum of jobs data continues to be to the downside, and we also see unemployment rate continue to trend to the upside, it's all about the direction of the jobs numbers, right? So if unemployment rate, which is percentage of people unemployed, if that continues to rise, that is not a particularly promising thing for the US economy, but we're not at dangerous levels yet. But if inflation risks are on the rise and we see less rate cuts, does that mean the stock market will crash? Well, the answer is it kind of depends. What are you talking about when you say the stock market? If you're talking about the S&P 500 and the NASDAQ, which are largely comprised of AI winners, I would actually say maybe not. AI, stocks have continued to surprise everybody in terms of putting up earnings growth, specifically for the mega tech companies, Google, Amazon, Apple, Nvidia, those kinds of companies continue to be winners at the table. But if you're talking about less rate cuts, like for example, stocks that are smaller in nature, like the Russell 2000 index, which is a collection of 2000 still big businesses, but much smaller than the mega, ginormous S&P 500 companies, these stocks very well could enter into a downward market. In fact, that's been the theme the last few years as interest rates have remained relatively high to, the 10-year average. And so these stocks have not done very impressive compared to, say, the NASDAQ, which has been in this massive upward trend, which the main reason I would say is that they are less sensitive to borrowing costs that are sort of trickled down from the Federal Reserve's target interest rate. So this is why personally, I do think that we are likely to get some rate cuts, and the Russell is also a buy to me, but I'd be interested in buying specifically the NASDAQ if we were to get some constructive pullbacks. And I know I've been saying that for some time. We looked like we were pulling back last week, but in came the bulls and we are back towards those all-time highs. And so yes, there are some things that are worth being a little bit cautious around, like the jobs data worsening, but it's not at critical levels. And there's a possibility that if we do get rate cuts and economic growth continuing, the jobs data could sort itself out. So we'll see. And again, we have a huge week ahead because on Friday, we get the big one. The non-farm payroll numbers come out, aka the jobs report for the US is coming out. And look at this, guys. When we actually look at the forecast, we're expecting just 51,000 jobs added, which is a pretty low forecast. I mean, we're talking about an economy that has over 330 million people in it, and we're talking about adding just 51,000 jobs for the month of September. So there's no doubt that we're in a weird environment because we have very low hiring happening in the US, but we also have low firing rates in the US as well. We're not seeing huge layoffs. We're just also not seeing huge hiring surges. And all the while, we're still seeing AI companies improve efficiency and cut some of the more junior job roles, which is a kind of scary thing to think about. But I went to school for programming, and I'm seeing all these things about how companies like Microsoft, for example, are hiring less junior programmers because AI is helping to kind of rule those jobs sort of obsolete. Kind of scary and a little bit dystopian, but I do have a positive note when it comes to new technologies. And while there is a ton of pessimism out there around the idea that AI is going to take all of our jobs and we're all going to be living in armchairs doing nothing all day, like in WALL-E, the AI overview here shows something that I think is really interesting. It is a historical pattern where new technologies like the computer or internet often eliminate existing jobs initially, but also create new unforeseen roles in industries, leading to job transformation rather than a net loss overall. While AI and automation are currently causing job displacement, especially in tasks that are manual or monotonous, they are simultaneously spurring demand for new roles and fields such as machine learning. This is a pattern, and we as humans sort of do the same thing over and over, where we initially think a new technology is going to rule all of our jobs obsolete and we're all just going to be useless. And then we find later, as time goes on, that new industries, new job creation that none of us were thinking about start to become more apparent. And so I actually think AI and automation and all this stuff is going to make us more efficient, and we're going to be doing cooler things as a human race, not thinking that, we're all going to be obsolete and ruined by AI. And even if that does take the place, I'd rather be an optimist because, being a pessimist sounds just like a lot of work. So instead of reading all the doom and gloom, what I like to do is keep an eye on the US economic data. If you're actually talking about trading setups, keep an eye on this stuff because, again, I call it the wind in the sail for a reason when it comes to trading, because knowing what the data is telling us about the state of the economy can help us to find better overall trades. GDP growth in the US is still very strong. Services PMIs also came in much better than expected. Retail sales have been strong. So when I look at this, I get a mixed view overall for the US, but I see, again, some optimism in terms of growth metrics. So I can't really give a solid, decisive, like I'm super bearish on US stocks or bearish on the US dollar, bullish. I have kind of a mixed view, but I will tell you, I am a little bit more partial to being long the dollar, even though you're only getting a 44% score. I'll explain that now. If we take a look at the economic surprise meter, what you'll notice is that most of our major currencies are actually doing something kind of interesting. Notice how everything except for the US dollar is in the bearish territory. The currency economic strength page showcases economic scores for each currency. A higher score indicates that the majority of key economic metrics like GDP, PMI, CPI, etc. have recently been strong relative to economic forecasts. And a lower score indicates that the majority of key economic metrics have recently missed expectations relative to economic forecasts. So for most of our currencies, we're actually getting some pretty low scores, but the US is holding up better than the rest, it seems. It's sort of a best of the worst scenario right now when it comes to economic data. And so when we filter the Edge Finder on the top setups page, you can see that the US dollar is actually getting a very strong reading because relative to its peers, the dollar actually seems to be holding up well on an economic standpoint. Things like dollar CAD, dollar Swiss, dollar yen are getting bullish readings, and then Kiwi dollar, Aussie dollar, and Euro dollar are getting bearish readings. And as we discussed in the Sunday video, dollar CAD actually got a strong reading going back as early as September 5th. So we've been getting some signals that the dollar is actually looking strong relative to its peers again. And dollar index is also kind of pulling back here today. So I'm looking for some possible setups. But before we get into that, remember that if you do not already have access to the Edge Finder, there is a free way to try it out. Down below in the description, if you want to try out the free demo version of the Edge Finder on our website, make sure to use the form link in the description to get access to the Edge Finder free version. Simply fill out this form, takes about 1 minute, and we'll send you a link to try out and explore the free demo version of the Edge Finder. We'll also send you some information on if you would like to try it for a full month, the full version fully unlocked, you can do so with that form again. There will be some information that gets sent to your email. What the Edge Finder specializes in is it tracks a collection of sentiment, technical, and economic data scores and automatically builds a bias based on the data that it finds. It does what the human mind just can't do all at once. It scans a ton of data and simplifies it into bullish and bearish readings for us to then look into as a potential watch list. So if we're going through our watch list here today, let's take a look at some of these ideas. We know dollar CAD is getting a bullish reading on the Edge Finder, so I do actually like the potential of getting long dollar CAD, but would wait for a pullback to this area for possible sort of better risk to reward. Dollar Swiss franc is one that I'm not really interested in simply because the technical chart on the daily still looks very bearish. Dollar yen, however, looks really good. Let's check this chart out. So dollar yen has been in consolidation for the last few months and finally broke out with some really nice strong green candles here, now showing a little bit of a pullback and approaching the 38.2% retracement zone. I really like the upside for dollar yen, and I'm looking into possibly taking a long position. And if I take this trade, I'll share it inside of our Discord VIP service, which can be found in the description down below as well. If you're interested, you get access to every trade I take in full context and in full details, why I'm taking the trade, my entries, my exits, chart markups, etc. So if I do take dollar yen, I will share the full breakdown on the trade inside of our Discord group, which will get notified directly to your phone or to your desktop, depending on how you set it up. And it's a very simple process to join. If you're interested in finding out more about our VIP group, the best way to get started is to speak to a member of my support team who can set you up with a membership for a nice subscriber discount. Simply scan the QR code on the screen right now, and you'll be connected to a real person on our team. Alternatively, you can just go to our website, a1trading.com/VIP to get access. So I do like dollar yen quite a bit, and I'm looking for upside there. The other one is euro dollar. Euro dollar has sort of topped out. We saw a little bit of a push through these highs that was met with some failure. Sellers came back in, pushed lower, and then a little bit of a lower high sort of formation in this recent upward trend. So it actually looks like euro dollar is turning, but to be completely fair, I actually like dollar yen a little bit more because euro dollar has been in such a strong upward trend. I like this one a little bit less. Specifically euro dollar, I really like if you start to break through the 116 level. I do think that that starts to show sellers are in full control, and I still think that you're sort of at these levels, still in the context of what has been a really strong upward trend for euro dollar. Pound dollar, I have a completely neutral view. The Australian dollar is very similar to the euro, where you've had this nice overall upward trend here in recent times. So I don't really want to fight that upward momentum. And also, if we're drawing fibs from the lows to the highs here, we did get a really strong reaction at the 61.8% retracement level. So if I'm watching AU, I'd be looking for a break through those lows and then pullbacks, maybe some continuation from there. Kiwi dollar also actually looks like it's in a downward trend that it's a little bit more sustainable. So this one might actually be a little bit of a Fibonacci retrace setup. So if I draw in this, zoom in a little bit here, this past level here could potentially be a supply zone that I'm looking to sell into. So same kind of context here. You have this low, so we can actually just move this a little bit local. Let's move this over. And so you have some potential resistance around this area here, this prior low. But I do like that 38.2% retracement. So Kiwi dollar looks like a possible short if you were to get a little bit of a rally, a little bit of dollar weakness this week. As for the indices, as I mentioned earlier, they still look like they are still in decisive upward trends. As we talked about in the Sunday video, this is just not a market to fight. It just seems to want to keep going and going and going. And, you know, yes, I do think it's a little overstretched, and I think that all-time highs are not really worth chasing. But to be completely fair, I've been saying that for a little while, and the stock market has continued to move up. But just remember that when stocks move down, they do so very quickly. They can suddenly be down, you know, 10, 15% in just a few short weeks. Like, for example, in April, when the stock market pretty much wiped out significant amounts of gains that it had made over the last year before that, right? If we go back all the way to, you know, December of 2023, that was 465 days worth of gains pretty much knocked out in a few short weeks. So that is the thing to note about stocks, is they typically drift higher slowly and then drop very sharply suddenly. When it comes to gold and silver, I'm a buyer if we were to get some bigger pullbacks, but there's simply nothing to do up here. Today's video is sponsored by Black Bull Markets. Black Bull is a New Zealand FMA regulated broker offering Forex, metals, and crypto trading to their users. With access to over 26,000 tradable instruments, everything from gold, commodities, indices, and more, through their CFD platform, you can trade pretty much anything. They're also backed by one of New Zealand's largest investment management firms and provide institutional grade trading conditions. Black Bull Markets has also earned multiple industry awards for their fast execution speeds and their leverage trading opportunities on their platforms. Traders can access up to 1 to 500 leverage and choose from several platforms like MT4, MT5, CTrader, and TradingView. And something super cool is that they offer no commission on crypto trading, as well as highly competitive spreads, especially on Ethereum. And for a limited time, active traders can receive free TradingView Premium and up to $60 reimbursed every month just for trading with Black Bull. And if you're interested in copy trading, they have an expansive platform just for that. You can see real trading results from other traders in a live environment through their copy trading platform. And when it comes to choosing a great brokerage, choosing one with competitive trading costs in the form of spreads and commissions is very, very important. With their ECN Prime option, you can see spreads from 0.1 pips, which is pretty crazy. And of course, if you're a larger trader, this institutional package looks incredibly competitive, with spreads from 0 pips as well as a $4 round turn commission. Of course, there is a minimum deposit on this, but all three of these look highly competitive compared to the industry. Make sure to use the link in the description down below. We'll leave all the information you need to start trading with Black Bull and start taking your trading to the next level with their amazing platform, their competitive spreads, as well as their copy trading platform if that's something that you're interested in as well. So like I said, make sure to use the link in the description down below to support my channel and also to check out Black Bull to see if it's a right fit for you. Now back to the video. Hope that video was helpful to you, and I also wanted to make sure to share our Telegram channel with you. Every day we are posting up chart markups and analysis and in-depth breakdowns of what's going on both fundamentally and technically in the markets. We also drop bonus videos in the Telegram channel, so don't miss out. Come join our Telegram channel. The link is in the description down below. Have a great rest of your day.